Welcome to Bunnex Investment Group, a channel dedicated to make you a better trader. In this course, we are going to talk about everything you need to know on candlestick patterns, and below are the topics we will actually run through. The first thing that we will talk about is introduction to candlesticks, which is basically a theory. Then the second thing is types of candlesticks. The third thing is trading with candlesticks, which is basically a strategy. We'll actually go over the charts to show you how to exactly apply the candlesticks that you have learned. And the last thing is conclusion, whereby we'll actually conclude everything that we have learned. So you will probably need somewhere to jot down some notes as we will be going through the slides. But before we jump into the whole video, make sure to hit the subscribe button and check the notification bell icon so that you do not miss any of our videos. You may as well like to check out our free Telegram channel where we share signals, analysis, as well as trading advice. So basically, what are candlesticks and what are these within the trading industry? I'm sure you've actually heard about them. So a candlestick is basically a type of a price chart used in technical analysis that displays the high, low, open, and closing prices of a security for a specific period. By security, we only imply to tradable assets like stocks, commodities, shares, bonds, or even forex. So candlesticks actually originated from Japan, from a rice trader called Homer from Japan. The candlestick chart is the same as the line chart, but this one includes much more detailed information on the pricing of a stock. So let's actually delve into how they actually look. So this is the basic candlestick structure, and as you can see, we have a green one. In this case, this one is not in red. It's normally in red if it's going down, and in green when it's going up. So the basic things that are on each and every candlesticks is it consists of a high price and a low price. By high price, it actually implies the highest price the market has reached in that specific time. Let's take for instance, if this is a H4 candlestick, we are trying to say within the last 4 hours, our highest price was this price. And within those last 4 hours, our lowest price was this price. And when the tick clocked at o'clock, or let's take for instance at 4 o'clock or 8 o'clock, in multiples of 4, we are trying to say that the price opened at this point. So this is basically the opening price, and within those 4 hours, when we reached the maximum time a candlestick of 4 hours can have to close, we mean that the closing price was this one. So this is basically the opening and the closing price, the high and the low, and we also call this the body, as you can see. Then these are the lower shadows or wicks. So wicks are important for us in drawing what we call the demand and supply zones. So we use wicks, and it is important for us to take note of these right now. So a candle shows the opening, closing, high and low price for a certain time period, as we saw in the chart above. When a candle goes up in a time period, it is colored in green, and if it goes down, it is colored in red. This is how it looks when a candle is going up. For this candle, the first trade of the day actually was made at $90. This is implying in stocks. So the first trade of the day, or the opening of the day, was at $90, which is the opening price. And then it moved around until the last trade of the day at $100. So this is the closing price. But within this day, this candlestick is actually representing a price move within one day. Within this day, the lowest price that reached for this particular stock was $86, and the highest price that we reached in this particular day was $112. So from the template that I have showed you above, this becomes the highest price, the lowest price, the opening price, and then the closing price. So this was basically a $10 price increase, which makes it a green candle. We opened here, we had our low here, but our closing price was $100. So we are basically saying this stock appreciated with $10 since it started at 90 and ended at $10 for this day. Then when a candlestick is actually going down, it is usually colored in red, although we can customize these colors. So in this case, we are actually saying the opening price was $100 and the closing price was $90. It's basically an inverse of the above example. Then the highest price in this case is $112 and the lowest price is $86. So in this example would be a candle with a decrease in price where the opening price began at $100 and closed at $90. Then candlesticks in build-up. On most trading platforms, there are several time frames. Smaller time frame candlesticks build up higher time frame candlesticks. It is true that in one daily time frame candlestick, there are 6 H4 time frame candlesticks. What we are trying to say, we are basically trying to say candlesticks actually adds up together to give us a structure of the resultant addition. This is an example whereby we have a falling candle or a dropping. In this case, we are saying this is going down and this is going up. Let's take for instance, this was an H1 candlestick and another H1 candlestick. Given the chance that we can attain the H2 candlestick time frame, this is how it will look. This part has been eaten with this one when we added them, and we have a resultant of this pattern. Then the inverse is also true. When this was actually going up and this was actually coming down, adding these two will actually result in this pattern. So before we talk about candlestick types, we'll have to highlight a few facts. And the first thing that we have to talk first is candlesticks, when combined in twos or threes, give us a nameable pattern. Then these patterns are most likely or mostly used to catch potential reversals within the market. They are much powerful when viewed on higher time frame than on lower time frame. Why? Because the lower time frames have a lot of noise. So to successfully trade candlestick reversal patterns, H1 and H4 can be implemented. Some would love to even go on the daily time frame, whereby if they enter a trade, they will actually hold that trade for several number of pips. So here are the types of the candlesticks that we are talking about. There are a lot of candlestick patterns in the industry, but to avoid being a jack of all, we will focus on one, the railroad track pattern. I'll actually talk about them later. The engulfing pattern, which basically has the bullish and the bearish. Then the 3 candlestick pattern, which is the hammer and inverse hammer. Here is how the railroad track pattern looks like. In this case, we have actually combined the buying setup and the selling setup. The first thing that we all have to do in order to trade candlesticks is to have a zone of interest, a point where we actually anticipate them or where we actually expect them to present themselves. So in this case, this is a resistance or a point that has actually showed in the past that price is reversing on that point. In this case, we would expect that the market once came here and came back again. So in this case, we are expecting a bearish move. Then in this case, whereby we have a support, we are trying to say the market once came to the same support and it came back, and we are now expecting a rise. Within the railroad track, we have likely equal candlesticks with different colors. Although this may not be perfect all the time, they will be likely equal in size. Then the engulfing pattern, which comes in two, is the bullish and the bearish engulfing pattern. It's basically seeing a candlestick that is bigger than the previous one. The preceding will be smaller and the one coming after will be bigger, as you can see within this example. Then the three candlestick pattern, hammer and inverse hammer. This is the perfect scenario of these candlesticks. There will be actually a downward move. After a downward move, up to a point that we refer to as the zone of interest, we see three candles that actually arrange themselves in a reversal format like this one. We have a red candle, a green candle, and a green candle. And the inverse is also true, whereby we had an upward move and we had a green candle, a red candle, and a red candle, and we are now expecting for a potential downward move. However, on the actual charts, they may not be as clear as these ones. So that is why we use the zone of interest in order to trade these candlestick patterns. Then here is the candlestick pattern strategy, and we are actually going to talk all its parameters before we go on the charts. Since we now know the types of candlesticks, we can now formulate some strategies to have an edge within the market. There is a simple strategy called the naked H4 supply and demand zone. Any trader who has logic must be able to understand this. So this is a chart example of everything that we were trying to say, and in this chart we are now trying to trade everything that we have been talking about. This is USD against CHF, and we want to see where we can actually get the entries and the setups. So on the strategy, which is H4 naked chart trading, all we have to see is to see a structure of this manner, whereby we first confirm the trend. After confirming the trend, we need to wait to see a retest of the previous resistance like this. So in this scenario, our zone of interest is this one, where we are going to be looking for the candlestick patterns, right? So as we can see that this was the lowest point. From the lowest point, the market is actually giving us an upward move, and our bias in this case is to look for only buyers. As you can see, the market came down here. After it came down, there was this point of reversal, and after that point of reversal, we had a break of this point of reversal. As I said earlier, that we are expecting to see a break, and the retest zone is the zone that we expect to see the candlestick reversal pattern and enter the market in direction of the market context. So this was the zone, and the market came back to this zone. As you can see, we marked this as the resistance of the previous movement, and we broke that resistance, becoming the support in future. As you can see, we had the first candlestick, the second, and the third, giving us a 3 candlestick pattern, reversal pattern, and our entry was definitely going to be here, our stop loss below the structure. Then the market moved. Then as you can see, the market looked like it had a zone of resistance at this point. And the next thing that we do is to mark that zone of resistance and wait for the market to come back and retest that zone of resistance as a support in that manner. Then the market came back to that zone. As you can see, we had a nameable railroad track here. As you can see, there was no candlestick reversal here, but this was a nameable candlestick reversal pattern, which was going to allow us to go long and our stop loss below the structure. And that is where we reached. And this was also another zone of resistance. And we were waiting for this to be broken and to be retested. Let's see how that went. Unfortunately, the market did not come back to retest the zone of resistance, which was going to be the zone of support in future. So there was no trade, right? We entered into a consolidation phase and we marked this point as a zone of resistance. As you can see, the market showed that it came across a zone of resistance. What we are now waiting is to see a break of this resistance and a retest of that same resistance, right? Then the market showed us that it broke this zone of resistance. After breaking, we are now expecting to see the market coming back to that zone of resistance, presenting any one of the candlestick patterns that we've learned, right? What pattern can you see at this point? Yes, an engulfing pattern. As you can see, we had an engulfing pattern here, whereby we were going to enter and put our stop loss below the structure, right? And we had almost 80 pips from this entry. Then this was also another resistance point. As you can see, the market is coming there from this point, going down. What we are now expecting is to see the market breaking and retesting this zone. We should be reactive rather than predictive. So going down, we can see that the market did not cross this resistance zone, so there was no trade. However, the market is now showing us downward sentiment. So by downward sentiment, we haven't actually confirmed that we are now in a bearish market because the structure has not been broken. By breaking structure, we mean that the last lower high of the previous cycle has not yet been broken. So we are waiting for this low to be broken in order for us to deem the new market structure bearish, right? As you can see, we broke this structure. The lower high of the previous cycle has been broken. So what are we now saying? We are saying we are now in a downward move. The market came across a zone of demand or a support zone, and it bounced. What we are now waiting for is to see the market breaking this zone of support and making it a resistance. There we can see that the market has actually broken this support, right? And the market came back to retest that support, which is now a resistance. And we can see a 3 candlestick reversal pattern, which we are going to enter at this point, and our stop loss was going to be above the structure. As you can see, they came back again to retest, and our stop loss was still above the structure. and this was the last move of the market on USD CHF. Therefore, we should have had a trade in this zone using this particular strategy. So that is basically how you will be doing everything. The first thing is to see a point of support or a point of resistance. We have to wait to see that point of support or point of resistance being broken for us to enter within the market. We do not have to jump right after seeing the market breaking and enter as breakout traders, but to wait for the market to come to us and tell us that we have retested the zone that we have marked earlier, and look for a candlestick pattern that we have been discussing. So that is basically what I was trying to impart to you in this course. It's a short course and direct to the point. Try to backtest it as much as you can so that it will actually get into your fingertips. And thank you. In conclusion, follow your plan without deviation, distracting thoughts, or hesitation to act. On that note, thank you for watching. Like and subscribe and check out our free Signals Telegram channel. This is the link in red.